April 29th, 2026, after the bell. Microsoft posts one of the cleanest earnings reports in its history. Revenue, $82.9 billion. Beat. EPS, $4.27. Beat. Azure, up 40% year over year, not slowing, accelerating. AI annual revenue run rate, $37 billion, up 123% in a single year. The stock dropped. Not by much, about 1% on the day, a little more after hours. But here's the thing. Microsoft hit every line that mattered, and the market still refused to pay. And if you understand why, you understand the single most important question hanging over the entire stock market right now. Because what we're watching isn't a tech earnings cycle anymore. It's a $700 billion bet. And no one, not even Microsoft, has proven yet that it actually pays off. This is the cloud Capex cycle. And until you understand it, no opinion you have on big tech is worth holding. The number that doubled in 2 years. Let me give you one number that summarizes the entire 2026 market story. $700 billion. That's the combined capital expenditure plan for 2026 from the 4 biggest hyperscalers. Microsoft, Amazon, Alphabet, and Meta. Servers, chips, power, cooling, land, concrete, networking, all of it. Now look at the pace of escalation. In 2024, those same 4 companies spent just over $200 billion combined. By the end of 2025, the number was around $410 billion. For 2026, they're now telling investors it'll land somewhere between $700 billion and $725 billion. So we're talking about 3.5 times more spending in 24 months. To put that in perspective, $700 billion is bigger than the entire annual GDP of Switzerland. It's roughly equal to the combined defense spending of every NATO country except the United States. And every dollar of it is going into one thing: the physical infrastructure of artificial intelligence. This isn't the AI hype cycle. The hype cycle was 2023. This is the heavy industrial cycle, the pickaxes and shovels phase. And it has completely transformed what these companies actually are. Why this isn't a software story anymore? Here's what most retail investors still don't get. Microsoft, Amazon, Google. These are no longer software companies in the way you've thought about them for the last 20 years. Yes, they still sell software, but the bulk of capital deployment and the entire investment thesis has shifted to something fundamentally different. Cloud is now a utility cycle. Think about a power company. It builds power plants, it buys land, it runs transmission lines. The economics are this. You spend an enormous amount of capital up front, you depreciate it slowly, and you collect predictable cash flows for decades. That's what the hyperscalers look like now. The infrastructure as a service market was already $171.8 billion in 2024. Now AI inference is moving into live production alongside training. Demand for GPU instances, storage, and high bandwidth networks is hitting all at once. But here's the twist most people miss. The bottleneck isn't chips anymore. Yes, NVIDIA still captures around 90% of accelerator spending. Yes, the supply chain is tight. But getting silicon is now the easy part. The actual constraint, the thing physically stopping these companies from monetizing faster, is power, permits, and physical interconnection. On its earnings call, Microsoft told the market it expects to remain capacity constrained through at least the end of 2026. Not because they can't get GPUs, because they can't bring data centers online fast enough. The real story now is happening at substations, county zoning boards, and high-voltage transformer factories. This is why looking only at NVIDIA gives you an incomplete picture. To see the actual flow of capital, you have to include Broadcom for networking. You have to include Equinix for the actual power-connected data centers and interconnections. You have to think about utilities, transformer manufacturers, even nuclear restart projects. The cloud is no longer something that lives in the cloud. It lives in concrete, the MSFT battleground. Now let's come back to Microsoft, because Microsoft is where this entire thesis gets stress tested. Microsoft is roughly flat over the past year. As of early May 2026, the stock is trading around $411. 12 months ago, it was in the same neighborhood. The all-time high was $555 back in July 2025. From there, it corrected nearly 30% down to $356 in late March before recovering. So here's the question every investor should be asking. How is it possible that the company with the strongest enterprise distribution in software history, the OpenAI partnership, and Azure growing 40%, is flat for a year? The answer is in 3 letters. Free cash flow. On the April 29th call, CFO Amy Hood told investors that Microsoft's calendar year 2026 Capex will hit roughly $190 billion. Of that, $25 billion is just from rising memory and component prices. Barclays now estimates Microsoft's free cash flow will fall by 28% this year before recovering in 2027. 28% decline in 1 year from the most reliable cash machine in the entire S&P 500. That is why Microsoft beat on every metric and the stock still fell. The market isn't disagreeing with the AI thesis. The market is repricing what AI actually costs to deliver. And in 2026, it costs a lot. Now here's what makes Microsoft specifically the battleground stock. Not Amazon, not Google, not Meta. Microsoft sells the entire AI productivity stack, not just rented server space. Copilot inside Office, GitHub Copilot for developers, Azure OpenAI service for enterprises, the OpenAI deployment channel itself. Their economic moat is still ridiculous. Distribution into every Fortune 500 IT department, hybrid cloud dominance, workflow lock-in that took 30 years to build. But moats don't pay this quarter's free cash flow. And until those Azure backlogs translate visibly into cash, the market is going to refuse to hand Microsoft the premium it used to get for free. One number tells you the demand is real, though. Their commercial remaining performance obligations, which means signed contracts not yet recognized as revenue, hit $627 billion, up 99% year over year. The demand is sitting there. The question is just timing. The 2027 question. This brings us to what I think is the single most important question in equities right now. Will the AI Capex translate into free cash flow by 2027? If yes, every hyperscaler is significantly undervalued at current levels. Microsoft at $411 is a gift. Alphabet's cloud backlog of $460 billion will print enormous cash. Meta will recover. The pickaxes and shovels names, NVIDIA, Broadcom, Equinix, keep running. If no, and Capex keeps escalating without proportional revenue conversion, you're looking at a multi-year compression in valuations across the entire sector. Not a crash, a grind. The kind of grind that's already been hitting Microsoft for 12 months, just spread across the whole stack. Now here's why this isn't actually a binary outcome. The demand is clearly real. Microsoft's $627 billion in commercial remaining performance obligations. Alphabet's $460 billion cloud backlog. Amazon's chip business hitting a $20 billion run rate. AWS still growing 28%. These aren't soft numbers. The demand is sitting in writing, on contracts. What's uncertain is the gross margin profile. Running a GPU cluster costs vastly more than running a CPU cluster. In power, in cooling, in depreciation per dollar of revenue. Microsoft Cloud gross margin has already dropped to 66%. That compression is the AI tax. The question for 2027 is whether efficiency gains, scale, and pricing power can claw those margins back faster than Capex depreciation catches up to them. That's it. That's the entire trade. Hidden winners and the lock-in backlash. Now let me give you the part most analysts don't talk about. There are 2 structural risks to the hyperscaler thesis that almost no one is pricing correctly, and both create their own set of winners. First, vendor lock-in pushback. Enterprises are getting smarter. They've noticed that egress fees, which is the money you pay to move data out of a cloud, are essentially a tax on switching. Regulators have noticed too. The UK's Competition and Markets Authority is already circling Microsoft on cloud licensing practices. If enterprise customers start adopting deliberate multi-cloud strategies just to avoid getting trapped, the big providers lose pricing power on the margin. This is structurally bullish for tools that enable multi-cloud. Broadcom, after the VMware acquisition, HashiCorp, Datadog. Companies that sit between the hyperscalers and benefit when nobody can monopolize the abstraction layer. Second, reliability under AI workload complexity. Running massive GPU clusters is fundamentally different from running normal cloud workloads. Failures cascade differently. Blast radius is bigger. When outages happen, they're catastrophic. Enterprise customers are already getting nervous. This creates a structural tailwind for observability and edge networks. Cloudflare, Dynatrace, Datadog. Whenever something breaks, panicked enterprise customers throw more money at monitoring and backup tooling. It's not a glamorous trade, but it's real, and it compounds quietly. And the silent winner of the entire cycle? Probably Equinix. They own the actual physical interconnection points where the cloud meets the rest of the world. Carrier hotels, cross-connects, the places where one network plugs into another. You can't replicate that footprint in 2 years. You can't even replicate it in 5. 3 signals to watch. If you're trying to navigate this for the next 12 months, watch 3 specific signals. Number 1, Azure growth in the next 2 quarters. If Azure stays at 40% or accelerates further, the AI thesis is intact. If it drops below 35% while Capex stays at $190 billion, the market will brutalize Microsoft. Watch the next print at the end of July. Number 2, free cash flow inflection in fiscal 2027. The first quarter of Microsoft's fiscal 2027 reports in late October 2026. That's the quarter where, if Barclays is right about a 2026 trough, you should start seeing free cash flow visibly inflecting back up. If you don't see that, the entire sector re-rates lower. Number 3, the egress fee regulatory story. If the UK Competition and Markets Authority, or the EU, forces material structural remedies on Microsoft around cloud licensing, that's the canary for the entire hyperscaler pricing model. It would mark the first crack in the lock-in mode. Watch closely. Closing. Let me come back to where we started. Microsoft beat earnings on April 29th and the stock fell. Most people see a contradiction. I see the most rational market behavior I've seen in a long time. The market is no longer paying for the promise of AI. It's waiting for the proof. And the next 4 quarters through the end of calendar 2026 are when that proof either arrives or doesn't. $700 billion says it does. The market, for now, is asking to see the receipts. If this kind of analysis is useful, subscribe and hit the bell. Next time, I'll break down which specific names inside this 700 billion stack actually have asymmetric upside if the bull case plays out. See you in the next one.